A DSCR loan is a mortgage for real estate investors where you're approved solely on how the property's rental income performs. That's right, no tax returns, no W-2s, no pay stubs, no additional income required. On today's episode of the SCI podcast, we're going to unpack all the fantastic nuances that the DSCR, or better known as the debt service coverage ratio loan, is for property investors looking to start or build their real estate portfolio. I'm Ryan Marks, host of SCI podcast, and we're here to peel back the curtain for self-employed borrowers and real estate investors on the fantastic loan products available to you. So let's jump right in. Debt coverage service ratio loan is a loan product that is available if you're looking to purchase a rental property, whether that's a long-term, meaning you have a tenant in there for 12 months and beyond, or mid or even short-term for those of you looking to purchase a property with the intention of making it an Airbnb or VRBO. These products work fantastically as far as qualifying with limited documentation and limited hoops that you have to jump through. Typically, when you purchase an investment property and you're using conventional conforming financing or QM loans, you have to provide the lender with at least 2 years most recent tax returns filed, and they're going to qualify if you can purchase this rental property based on the income that you make in your present profession. It doesn't really have anything to do with how well the property performs. Yes, you can use a percentage of the rents for future proposed rents to help offset that payment, but there's still a debt to income ratio associated with qualifying for that rental property. So for those of you who currently own rental properties, you're aware that on the Schedule E of your tax return is where you're listing all of your properties that you own, and that bottom line, whether that shows a positive or negative, is what the lender is going to use to take into consideration to offset those existing mortgage payments. In addition to that, you have to still meet the debt to income ratios when purchasing that new home, whereas a DSCR loan uses no DTI whatsoever. It's very similar to a commercial loan in a sense that the investor just wants to see how the property is performing. Is it breaking even? Is it making positive cash flow? Or is it not covering the current mortgage payment on the new loan? That's the only item that the investor is looking at when using this DSCR loan product. So that means property is making $1,000 a month in rent, and your new mortgage payment for that property is $1,000, which includes taxes, insurance, or any homeowners association dues. That is covering a 1-to-1 debt ratio, and that financing would be available just based on that property performing. Now, you still have to meet some credit requirements, meaning the investor is still going to use your qualifying credit score, as that is one of the pieces tied to what sort of interest rates you're going to receive. But in addition to that, there is limits on how low the credit score can go and still offer this type of financing. But the biggest thing to understand is you're not using your tax returns, or if you're a wage earner, your W-2s and pay stubs, and there's no DTI that's being calculated in order to qualify for this property. The loan pays for itself, the loan works. So how does an investor use this product and take advantage of the DSCR loan? There's a lot of ways that you can structure this loan, but before we fully unpack all the nuances of the DSCR loan, let's look at what a traditional conventional loan has associated when you're taking a look at financing options. So the biggest thing is you're limited with conventional financing up to 10 properties. So that means if you're financing 10 or more properties, you cannot purchase another investment property and use conventional financing. You've reached that limit. Whereas a DSCR loan, there is currently no cap on the amount of DSCR loans. So strategically, when I speak to my clients, we look at what type of real estate portfolio they want. If you're wanting more than 10 to 15 properties, it may make more sense to use the DSCR loan first as you build your portfolio, knowing that you'll have access to that conventional financing later down the road if your real estate portfolio continues to grow. Some other things to take into consideration are the DSCR loan, more often than not, does not even report on your credit. So that payment that you're making for your principal, interest, taxes, and insurance is not reporting on your personal credit report. And the investor strongly recommends that you take the vesting as an LLC or a corporation versus where most banks will want you to take the vesting individually or in a trust as long as it's a revocable trust. So the big thing to understand though is not all investors are the same. If you're working with a mortgage broker for that matter, you want to make sure if you're going to utilize this type of loan product, you ask them if this DSCR loan that we're going to be using is going to report on credit or is it not going to report on credit? Because again, going back to previous episodes, not all one size broker fits all. You have to make sure that they have access to a multitude of investors. So for example, if we're working with over 200 investors at any given time, we want to use the ones where if you don't want it to report on your credit for the purposes of if you're looking to purchase a primary residence for yourself in the near future, if you have all these other mortgages reporting on there, and again, you're using your Schedule E, and that's reporting a loss, that's going to be taken away from your qualifying income that you're using for your primary residence. The other big difference is when you're purchasing using conventional financing, and you're buying a home that's a 2 to 4 unit, so you want to buy a multi-unit 2 to 4 unit residential apartment building, currently you have to put 25% down or more on conventional financing, whereas the DSCR loan offers a minimum of 20% down. And in some situations, there's investors that will even go as low as a 15% down payment. One of the other major caveats to the DSCR financing is if you're structuring the purchase of a property where let's say your purchase price is $150,000, that's what the seller is requesting, and you want them to cover the closing costs, it may make sense for you to bring up the purchase price to let's say $155,000 or $160,000, but then ask the seller for a concession for that $5,000 or $10,000 that you can use toward closing costs or other recurring, non-recurring fees. So let me break that down a little more. The seller is still going to net the same amount. If they want to receive $150,000 for that property and you're telling them you're going to offer them $160,000, but you want $10,000 in credits, it will still net them $150,000 in proceeds minus whatever their fees, realtor commissions, or any outstanding loans. But then in turn, you can actually use those funds then to pay for your standard closing costs associated with the transaction. The reason why I mention this is because another difference between conventional conforming financing is when you're purchasing an investment property, you can't receive more than 2% of the purchase price towards proceeds. Now you can when it's a primary residence or a second home for that matter, but when it's a rental property, you're maxed out at 2%. So you may not be able to go up to $5,000 or $10,000 in concessions depending on how large your purchase price is. Whereas on these types of products, many of the investors allow you to actually go up to the standard 6% concession that's available on other types of finance. So this would help you better structure if you're going to be asking for funds after your home inspection, or how you structure the initial offer that you're going to make on that property, knowing you have a higher limit now to work with. Another big difference is when you're purchasing a property and let's say you hypothetically had the opportunity to go with a less than 20% down payment on an investment property, that loan would have mortgage insurance if it was conventional. Whereas the DSCR loan, similar to the bank statement loan product covered in a previous episode, some investors will allow you to go less than a 1-to-1 debt to income. That's why it's important that you have access to a lot of different investors who specifically offer the DSCR loan product, because some of them will allow you to go under a 1-to-1 debt ratio and still offer finance. Or in some instances, if you're putting a 25% down payment or greater, there's no ratio whatsoever, meaning regardless of how the property is going to perform or not perform for that matter, there's still financing available at that 25% down payment or greater. Or here's a huge pro tip. There's some investors out there where, let's say your property doesn't quite the 1-to-1 debt ratio coverage, and you have other assets like in a personal 401k or liquid assets, stocks, things of that nature, your personal checking or savings. There's actually investors where they will take those assets that you have and use a calculation to divide them out over a certain amount of months and essentially turn that into what would be monthly income. And they would attach it to whatever the property currently has as qualifying monthly income in order to push you over that 1-to-1 ratio, where then you don't have to utilize that 25% down payment or greater in order to qualify the property. So how does all this translate to interest rates when using the DSCR loan? So conventional financing is going to have more competitive interest rates because you are qualifying using a DTI ratio and you're fitting directly into that bank's box of how they weigh risk. However, the DSCR interest rates can be very competitive if you know how to properly utilize those or structure them. For example, a DSCR loan, because this is a non-QM loan, you do have the ability to utilize a prepayment penalty on the loan if you want to drive down the interest rate. So I know typically there is a stigma associated with anyone saying prepayment penalty, but let's break that down a little further. So when you're purchasing these properties at a lower ticket price. So for example, this home is valued at $150,000 or less. Interest rates are generally higher. And the reason why is because the servicer's not making money on this loan like they would if you were purchasing a $500,000 or $1 million loan, because there's a cost to originate this loan. Even though you're incurring expenses personally, there's a cost involved to originate the loan. So the investor, or the bank for that matter, has to recoup those costs over a certain amount of months before they break even, and then they start making money on the servicing, which is you making your monthly payment over the next months and years. So if you have a loan that's only $100,000 versus someone that has a loan that's $1 million, it may take the servicer 2 years to break even and start making money on the servicing, whereas the $1 million loan, they recouped it in a matter of months. So that's why, generally speaking, you're receiving a higher interest rate just solely based on how much you're financing. So in order to drive that interest rate down, you have the option between a 1 all the way up to a 5-year prepayment penalty on a lot of these programs, whereas if you took a 5-year prepay on a standard 30-year loan, you may be receiving 1% or higher, lower than the interest rate would be if there was no prepayment on this standard 30-year fix. So what it's important to understand though is, yes, there's a prepayment penalty and there's going to be costs associated if you were to refinance that mortgage or pay that loan out before that 1 to 5 year prepay penalty is up. But think about it this way. If it costs you anywhere from $3,000 to $5,000 in closing costs to refinance that loan, if the interest rate should drop within following your closing and you have that loan in place and the interest rates decrease, and let's say your loan again is only $150,000 or $200,000 that you're financing, even if you drop the interest rate up 1%, the difference in monthly payment would be so small that it would take you 3 to 5 years to recoup those closing costs that you paid to reduce the interest rate. Because fortunately and unfortunately, the closing costs are about the same within certain loan brackets as it pertains to like new title insurance and paying the escrow company and a processing fee and underwriting, all those one-time non-reoccurring expenses you go through whenever you purchase or refinance a property. Those fees never go away. So if you were to put a 5-year prepay on there and just ride it out, you may be coming out ahead because your interest rates in the low to mid 6s on an investment property and you're already positively cash flowing out the gate. And then as you further increase rents over time, then you're going to further increase your cash flow. Or there's other options where if you're trying to get creative and maybe you don't want to utilize a prepayment penalty because you have to write the property to get it performing better. Let's say you purchased it and you're going to put work into the home to bring up the property value, which would in turn bring up the fair market rent. There's actually interest-only payments available on these types of loan programs as well. So meaning if you went with an interest-only payment in order to make sure you're at the very least breaking even on the current rents while you work to improve the property, you would have access to go that route as well. But again, you want to make sure if you do utilize that it does not have a prepayment penalty, or the prepayment penalty is going to have expired by the time that you're looking to refinance the loan, or you're waiting for interest rates again to come down. So there's tons of different ways you can structure the purchase of your property when you're utilizing this DSCR loan. Another way is if you're wanting to purchase a short-term rental home, these loans actually have the ability to qualify using what's called AirDNA, meaning there's a third-party service that the investors will use where you can actually subscribe, and there is a monthly fee. I think you can check like one property and then you have to pay. But what it will do is if you put in your subject property address, the home that you're interested in, it will tell you what the likelihood of that property is going to make gross income for the entire year based on other comparables within the area. And then the investor will use that percentage of the AirDNA data in order to qualify to meet that debt coverage ratio similar to a long-term rental property. So depending on what type of home that you're purchasing or the intention of that home, whether it's a short-term, mid-term, or long-term, this DSCR loan can be utilized for all different types of properties and all different types of purposes as far as the rental income is concerned. Another huge factor is normally when you're using conventional financing, you can't go above a 4-unit property, meaning if you're going to buy like a duplex or a fourplex, it's 4 homes in one on your property. You can't go above that 4-unit property, or the bank considers it a commercial loan. And then you're truly in commercial financing, and it's completely different than these non-QM loans, these DSCR loans, or regular conventional financing. Where the DSCR loan, there's actually investors currently available where you can finance up to a 12-unit apartment complex using this DSCR loan. So it could have 12 actual units in one structure, and it's still not considered commercial as far as that investor is concerned. And it still uses all the same ratios to qualify, meaning if you're putting a certain amount of percentage down and it doesn't debt coverage, or you're hitting that 1-to-1 ratio, or even better, right out the door, it's performing better than a 1-to-1 ratio in positive cash flow. So another way you can use the DSCR financing, which a lot of savvy investors will do, is using that BRRRR method, right? The buy, rehab, rent, refinance method. So how that works is typically if you don't have the ability to purchase all cash for your property, there is hard money investor funds available where you can go as low as 10% down payments and finance interest only payments while you fix the property up. Once that property is renovated, you would use a DSCR loan to take back out your initial principal investment, meaning the down payment that you put on the property, because now you fix it up and it's worth more than your original purchase price. So for example, you purchased the property for $100,000, you had to put $50,000 of work in it. So you're all in at 150 minus your 10% down payment, but now the property's worth 300,000. You're at a 50% loan to value. You can more than take cash out to recoup that initial 10% down payment and then use a DSCR loan showing what it's going to rent for using 100% of those rents. Meaning if you order the appraisal and the appraiser lists rent comparables on the appraisal, that's called a 1007 or rent schedule, or you already have tenants in place and you have your signed lease agreements, you're going to use 100% of those rents as well. And as long as you're meeting your debt coverage ratio, you can take cash out, recoup your initial investment, go into a nice 30-year fixed mortgage where you're positively cash flowing, and then go out and do it again. You've just taken your initial principal back, and now you have the down payment again to go find that next property and do it all over. So I touched briefly on the initial financing piece because we are going to cover the specifics of hard money financing in a different episode. But just to simplify things, that second stage of that BRRRR strategy will be a great vehicle to use that DSCR loan in order to get into that long-term financing once you fix that property up and now it's performing and you have this additional equity as well. And if you have the additional funds available, you don't have to take a cash out refinance to recoup your costs. The rates generally are going to be better if it's considered what's called a rate and term loan, meaning you're just paying that hard money off, then you're going into a fixed 30-year product, but that's what you want to structure with your loan officer. So what do these interest rates look like? Typically, when you're doing a DSCR loan, if there's no prepayment penalty, it's a standard 30-year fixed mortgage, and you're doing, let's say, a 20% down payment, and it is covering 1-to-1 debt ratio, you're probably right now looking at rates in the mid 7 percentile, whether those come with any sort of additional points or not. That's the general baseline. But if you were to attach, again, utilizing a 5-year prepayment penalty, there are interest rates in the mid to potentially low sixes available with a prepayment penalty at that 20% down rate on a 30-year fixed mortgage. That may make the difference when it comes to actually positive cash flowing out the door. So if you're going to build your portfolio in the real estate space where, maybe the average home, maybe it's a duplex, right? It's a 2-unit home and it's only $140,000 for a 2-unit home. That likely won't appreciate as quickly as some other homes. Let's say you're purchasing in the California market, and just to buy like a condo over there is $700,000. It will likely appreciate at a higher pace. But again, if you're trying to build your real estate portfolio, is it more important to have that positive cash flow with not as much appreciation, or is it important to have a mix of both? So that's where you really need to figure out what your investment strategy is going to be as you utilize this type of product. Do you want to have a balance of just, I want to own 15 to 20 properties and that's going to be my residual income and I can just retire on that? Or do you want to have a mix of a lot of these properties perform, but some of them are only break even, but they're appreciating 8, 10, 15% a year in value, where then I can in the future use a DSCR loan and take cash out with no additional income documentation and go buy another property with the funds from that home that appreciated in value. One tip that I learned earlier on was, if you're going to use a property manager to manage your real estate portfolio, you definitely want to interview the property manager to see if they are really asking the right questions, aside from how much do I have to pay you of my rent to manage this property and you deal with tenant issues or evictions, to a property manager that's almost acting like a financial advisor, meaning they're going to ask you the long-term questions, like how many properties do you want to own? What do you want your portfolio to look like in 1, 3, 5, 10, 15 years? So that way they're best structuring the management of your portfolio as you utilize these different types of loan products. We're actually going to have a guest on in future episodes that will talk about all the nuances within property management and what makes a good property manager and what are the pros and cons of self-managing versus a property manager. But it can't hurt to get a head start on long-term big picture if you truly are trying to build a real estate portfolio, what you want that portfolio to look like and what sort of space you want to play in. Do you want to build a portfolio that you're just purchasing only turnkey ready properties from a wholesaler, or do you want to move into finding that distressed property where you put $15,000, $20,000, $25,000 into each door in order to bring it up to fair market value, and then again cash out or just go into that DSCR loan for the long term, and now you built or created equity for that matter into the home. So there's so many different ways or nuances you can do when utilizing this type of product. And it is personally the most fantastic investor loan product that's currently out there, just because there's so little restrictions and limitations to how it works as far as the financing is concerned. And again, just to recap, this loan does not require any tax returns or any additional income documentation. The loan is solely written based on how the property performs. You also have the ability to vest the property in an LLC or a corporation. There's investors out there where this loan won't even report on credit, so it doesn't affect future debt to income ratios if you are going with a full documentation loan for other investment properties or your primary residence. They offer interest-only payments. They offer lower down payments than a traditional conventional loan, meaning you don't have to go 25% down or greater when you're purchasing a 2 to 4 unit. It's also available over 4 units, up to 12 investors offering 12 unit property financing on this type of loan product. So you can see all the great ways this DSCR loan is perfect for self-employed borrowers, property investors. Even if you're a W-2 wage earner and you have limitations on your debt to income ratios, if you're trying to go conventional financing and purchase an investment property. So hopefully this put another tool in your toolbox if you are looking to build real estate wealth. And if you want to check out how to calculate the DSCR, you can actually head over to the SCImortgage.com website, where we have a calculator on there where you can plug in what the rents are versus what the estimated mortgage payments are and see if that's a good property that you're eyeing right now. And if you have a question, don't hesitate to reach out to us. We'd love the opportunity to connect with you or qualify you so you can take advantage of this great DSCR loan product. And on our next episode, we're going to be breaking down the profit and loss loan. And remember, let your money work smarter, not harder for you.